Welcome back. My name's Jordan Kennedy. This is Picture Perspective. Today, I've got the opportunity to welcome back Cameron Curko to talk all things markets and the economy. Thanks, Cameron.
Thanks, Jordan.
But first, this is general advice. Please, if you want to take personal advice, reach out to your advisor. Let's get going. So, Cameron, we saw a big sell-off in August off the back of recession fears. Is this something we should be worried about?
It's a fair question to ask because it was quite crazy. I think in Japan, the Nikkei was down almost 20% in just a handful of days. When we look at the situation in markets, so there were a few factors such as a lot of leverage in what was called a carry trade. And so basically people are borrowing at cheap rates and then using that cheap money to go offshore from Japan and buy US stocks, other foreign assets. And what happens is when the yen's value starts to rise, that trade unwinds and it can be quite tumultuous.
And it moves quickly, right?
Yeah, and that's one explanation for what we saw. The other one about US recession fears, look, there are definitely signs of a slowdown, but we're already starting to see policymakers move proactively on that front, and that's why people's expectations of rate cuts, especially in the US, have moved quite radically in the last month.
And is this also linked to political change as well?
I think that's a fair question. There's a variety of people that think, Trump will be good for stock X and Kamala will be good for stock Y. But the reality is, to shake it all out, it's going to be a complicated one, and there isn't any one perfect trade. But that's already a debate that's ongoing, and people are trying to position themselves accordingly.
And we saw, the Magnificent Seven tech stocks. We saw Nvidia move 12.8% in a day. Is this something that we're going to see more regularly? Is it something to be concerned about? These are big businesses now. I think, Nvidia is the same size as the German economy, I last read. What's your thoughts?
I think with the Magnificent Seven, they've been almost single-handedly the biggest beneficiaries of an upswing of interest in artificial intelligence, and that's seen stocks like Nvidia, which produces some of the leading chip designs, skyrocket in value. The volatility on a day-to-day basis, I think, to an extent, yes. And there's two reasons for that. On the one hand, the company's doing ridiculously well. It is like absolutely awash in cash, and it continues to print money in the near term. It's highly likely, particularly when they've got the new chip design Blackwell coming online. It's expected later this year. The second reason, market dynamics have changed. There's a lot of leveraged money out there. So I mentioned the carry trade regarding Japan before, but there's also an explosion of single day options. So that's the idea. You or I can bet on a company and the option expires at the end of the day. And that has seen a surge of interest, and we're talking tens, hundreds of billions of dollars.
Talking Australia, we've got the RBA saying, jittery, we don't know, we're going to hold for longer. We've got politicians saying it needs to come down. What do you think the track's going to look like?
So the trouble in Australia is compared to elsewhere in the world, inflation has been a bit more stubborn here. So if we look at the chart, what that basically shows is headline, underline, and wage inflation are all above the RBA's target band of 2 to 3%. And really, until the RBA starts to see a more meaningful move downward on that, all their indications are we're just holding, guys. We are starting to see some progress on that front, but it's something that's going to take time to filter through necessarily. A big one's going to be some of the budget measures the government announced back in May that'll help push inflation down. But there are longer term challenges for our economy. We've talked in previous sessions about housing insurance, the cost of utilities. There's one school of thought out there that utility prices are going to be permanently higher for good, like just in terms of the energy transition and everything else. And so that's not a conversation anyone's been willing to have just yet, but it's going to pose some real challenges. And the big difference between us and the US that is helping the RBA just say, we're going to be on pause. The labour market here has not broken in arguably the same way the US has. Like unemployment from there is up over 0.5% from its low point, and it seems to be trending higher more forcefully. That hasn't happened here yet.
What do we see ahead for the labour market here?
It's a tricky backdrop, but really we're seeing a case where the labour market is normalising. So job vacancies are down a lot from the peak in like 2021, 2022, but they're still well above where we were before COVID even happened. So in that sense, there's still quite a lot of demand for labour, and there hasn't really been a break in the job market just yet. We've also got arguably a closet financial stimulus program by the NDIS. So the amount of people we employ in nurse and carer roles in this country has absolutely skyrocketed relative to where we were pre-pandemic. And the third factor in the jobs market has just been the surge of government infrastructure and building and spending. That has really helped put a floor under the broader, I guess, construction industrial sector and helped keep a lot more people employed than normally. If the RBA would jack up interest rates as much as they have in this cycle, we would start to see a lot more pain earlier. But because of pandemic backlogs and these other government programs, that hasn't happened this cycle.
So business pain, small business, medium business, large business, are they hurting out there? What do we see coming ahead for them?
If we look at the large end of town, so in some pockets, confidence is really low. And the chart I've got there is just taken from the latest NAB monthly business survey. And business confidence in red is tracking near zero, which for context with this survey is below the long run average. And that's really the retail and wholesale trade sectors are really low on sentiment. And it's
because people aren't forward buying as much, big orders aren't coming through.
It's a combination of that and like these guys had really good times during the height of the pandemic when we were all stuck at home. That hasn't really translated to today's world. Now, that being said, actual business conditions, so what is really capturing how businesses are currently trading, is actually still in line with its long run average. So even though confidence might be on the low end, businesses are still performing broadly okay. And we have seen pockets of that even in the latest reporting season where businesses such as JB Hi-Fi, for instance, were still performing materially above expectations. So even though profits were down, they were down considerably less than what investors were anticipating. And so the trade for, I guess you'd call the wealthier end of town, people that typically own their own homes or even with a mortgage, that activity has tended to trend well. And you see that in Combank does a credit card data series. And basically homeowners, even with a mortgage, have continued to maintain their spending. It's the people that are really struggling are the renters. And you see that come through this reporting season as well, where people of sort of lower wealth typically have cut back and pulled back spending considerably. And even it's on stuff you wouldn't necessarily think about. So Collins Food Group, who own KFC and Taco Bell here, they had a dreadful report, and you're also seeing that in other pockets of like fast food. So even those little pleasures of life, people have cut back.
People have gone fast and hard back to basics, right?
Yep, absolutely.
Cool. And from a stock specific, we saw some pretty wild moves down for BHP and Rio. What's driving those movements?
Yep. So the BHP and Rio story is really one of iron ore prices. Both businesses are much less diversified than they used to be. So iron ore is really critical to their bottom line. And what we've seen in China is basically the problems within their residential property sector have just continued to persist. And the other factor is what they were doing in response to that is, okay, we don't have the demand here. We're going to export more overseas and we're going to build up a lot of steel and send it offshore. Problem with that is other countries can only receive so much steel without destroying their own steel production industries. And you've already seen like tariffs and that imposed on Chinese goods to prevent the dumping of cheap products. And really that whole backdrop for China is just, it looks like a grind in lower growth environment. And so that's leading people to price in lower iron ore prices. And what that chart up there also shows you in the black line, just a build-up of port inventories. So you've also got a case where there's this build-up of excess supply, and until that gets wound down, it's just going to pressure iron ore prices, which are shown there in blue and have dropped considerably over 24.
So Cameron, are you seeing any changes to the broader economic outlook?
Globally speaking, over 2025, we're expected to see a slight recovery in Europe to start with, and that's mainly a case of they've been a bit of a basket case in recent years. The Ukraine invasion by Russia has really impacted the region hard, especially Germany. But we're expecting to see a slight pickup from those lows. In terms of other countries, US slowing down a bit more. Like they've been running pretty hot for a while now, some of the fastest growth rates in the developed world. That's expected to subside a bit, particularly as you're starting to see weakness in the labour market emerge. China's very difficult, but the expectation there is, given the government has been very reluctant to go hard on the stimulus angle, we're expected to see a period of weaker growth in China continue to persist. And how does that all flow through to Australia? The Australia backdrop, again, has its own complications, but what we're expecting to see in 2025, a supportive RBA come into the table with rate cuts, which should provide some relief to households that have been cutting back. We would expect to see a slight pickup in Australian activity. The magnitude is the real question mark there, because the concern is, while the RBA is staying on hold, there is damage going on, right? So basically the construction development sectors.
Insolvencies are gone through the roof.
Insolvencies have skyrocketed as well. And so that even though there are big pockets of Australian industry that's doing well, at the smaller end of town, there's a lot more struggle going on. And the concern is, if the RBA keep things on hold, will they inflict too much damage that by the time they start cutting, they might not have to move in like gradual 25 basis point cuts, but much more forcefully. And generally speaking, the labour market is strong enough that that sort of extreme alarmist scenario seems unlikely. But it is a risk that exists, definitely.
Thanks, Cameron. As always, a really interesting perspective. Thank you so much for your time.
No worries. Thank you, Jordan.